Good morning, and welcome to today's webcast, Investing Insights, Macro, and Markets. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right. And with that, I'll turn it over to Dominic to get us started.
Thanks, Chad. Good morning, everyone, and welcome to another installment of Macro and Markets. I'm Dominic Cellitti, Senior Financial Advisor at Moss Adams Wealth Advisors, and I'm once again joined by our Chief Investment Officer, Michelle Walker. We're excited for everyone to join us again to talk through our thoughts on the economy, the markets, and what's on the horizon for investors. So let's get started. Equity markets have generally rallied into the first quarter this year, riding on tailwinds from last year. As we see on the chart here, the S&P 500 and NASDAQ posted nearly double-digit returns, with the Dow lagging a bit at 5.6%. Although still positive, small caps have continued to underperform the greater market with a 4.8% return. So, Michelle, can you walk us through a brief recap of the first quarter, where we've seen momentum and why, and also what have been some laggards in the market?
Yeah, absolutely. So Q1 was indeed strong for stocks, fueled by a combination of strong economic data, resilient corporate earnings, and expectations for lower interest rates. Stocks surged during the quarter, and as Dominic mentioned, the S&P 500 finished up over 10%, and that was the largest first quarter gain since 2019. Enthusiasm around artificial intelligence continued to be a theme boosting technology stocks. However, unlike last year, the rally broadened out to some of the more cyclical areas of the market. The strongest sectors in Q1 included communication services, industrials, materials, energy, and financials. The momentum in the more cyclical areas of the market, like industrials, materials, and energy, was supported by stronger economic data, as well as the secular tailwinds of a U.S. infrastructure boom, which we will talk about a little bit more later. The lagging sector was small caps. Some sticky inflation numbers towards the end of the quarter caused rate cut expectations to be pushed out further this year. Small companies tend to be more leveraged than larger ones, and typically with expensive floating rate debt. So that higher for longer narrative that we heard during March was definitely a headwind for small caps.
Yeah, I think it's important to point out here that this has been the most rate-dependent asset class this cycle. I mean, for small caps this year so far, like I mentioned, they've underperformed the S&P 500 by about 5%. And if we look further back to the beginning of last year, that gap widens to 15%. Right now, as we talked about last time, we're in the Fed rate plateau or pause, where traditionally this asset class, it may have outperformed. But similar to our discussion last time, I think rates really aren't affecting the broader economy as much as they really are smaller companies. So small caps certainly are feeling these higher rates right now. But I still believe this is an opportunity to see them rally and close that gap once these cuts come to fruition or when the market looks forward to them. So that'll be interesting to see that play out. So moving on to the health of the economy, Michelle, not to jinx us, but it feels like we're out of the recession cloud that loomed over us all of last year, kind of every corner. Michelle, are we still seeing not only consumer spending and savings, but also a generally healthy economy as a whole?
Yeah, so the U.S. economy has defied widespread predictions of recession. You and I discussed this in the January webcast that the majority of economists last year were calling for a significant slowdown. And not only did we not get the recession, but the economy has turned out to be quite strong by many measures. So let's start with the labor market because it's been the key to the soft landing narrative. While the labor market has normalized from its post-pandemic boom, the US economy still added 250,000 jobs per month in 2023 and has sustained this pace into early 2024. The unemployment rate has been maintained below 4% since December 2022, and that's the longest streak of low unemployment since the late 1960s. And after falling sharply during the pandemic, labor supply in the US has staged an impressive recovery over the last 2 years, largely due to increased immigration. And this has allowed employers to steadily hire workers and narrow that gap between supply and demand issues.
Okay, so biggest takeaway here on this slide for me is wage growth is above all current measures of inflation, which we'll discuss a little bit later today. But that's been a trend since the fall, and as a lot of economists look at it, is kind of a Goldilocks scenario. We have wages going up and not being wiped out by a commensurate rise in prices. So there's a lot of hesitancy out there about how well the economy has been doing. But to me, this is a great sign that things are doing okay and workers are getting by.
Yeah, that's exactly right. Real wages are finally positive, and that combined with a strong jobs market has contributed to solid economic growth. As you can see on the slide here, nearly 68% of US GDP comes from consumption, and the consumer feels emboldened to spend when they feel confident in their job and are benefiting from real wage growth. Economic growth, or GDP, for the fourth quarter of 2023 came in at a surprising 3.1% and marked the 10th consecutive quarter of growth at or above 2%. Expectations for Q1 2024 are for a slightly cooler 2.4%. And while the economy may struggle to match last year's performance, 2024 looks set to be another year of expansion. So looking closer at consumption trends, much has been made of the inevitable cooling of the consumer, who should be getting more tapped out as inflation and high interest rates take their toll. Largely, however, the consumer has been strong, supported by the tight labor market I just mentioned. And though you can see here that certain indicators are ticking up, like revolving credit as a share of disposable income and auto and credit card loan delinquencies, these indicators still look solid relative to history. And as a testament to the old adage, never underestimate the power of the US consumer to consume, retail sales figures released for March just blew away expectations. So we just aren't seeing it yet.
Yeah, so for the audience, just a reminder, my main role at Moss Adams as an advisor to our clients. And I think increasing debt balances is the number one question I've been getting from clients when we discuss their concerns about the economy. So when I look at the paper or watch the news, every kind of doomer headline I read includes the same thing here. We're reaching historic consumer debt levels, but none of them are really addressing it on a relative basis, only on a nominal one. As we all know, our economy and our personal balance sheets grow over time, but especially over the last 4 years with all the stimulus in the system. So, of course, the nominal level is going to grow too. So, Michelle, as you said, on a relative basis, we're still below long-term trends. So, in my opinion, that should comfort some who have concerns about increasing personal debt levels.
Yeah, exactly. And as a further counter to those negative headlines, US consumer sentiment is on the rise. Sentiment rose significantly in March, supported by strong stock market gains and expectations that inflation will continue to ease. The University of Michigan's sentiment index climbed to its highest level since mid-2021, and Americans surveyed said they expect inflation to continue to wane. Consumers' views about their current personal finances rose to the highest levels in over 2 years, while their present outlook for the economy improved to the best since July 2021. Both the current conditions gauge and measures of expectations rose to highest levels in 3 years.
Okay, so let me jump in here with another observation from this chart. So again, coming from my perspective as an advisor, often we get asked about market timing quite a bit. Every trough I see here has a positive return associated with it looking forward. And then if we look at the peaks, a little less than half of the peaks have positive returns associated with them. But if you average out those forward returns on the peaks, you still have a positive return, given the market going up substantially more than it went down. So this tells me, even if you could time these sentiment peaks and troughs perfectly, stay invested for the long term.
Yeah, definitely. Though it's challenging to do at the time, investing when sentiment feels the worst has always been a profitable endeavor. So, now moving away from the consumer, just one last bit of data on the economy, and that's business spending, which is also managed well through a tighter lending environment. Increased spending on intellectual property and infrastructure with greater emphasis on developing artificial intelligence capabilities and security has been a strong tailwind, and we expect to see that continue.
All right. So I'm going to bring up the elephant in the room, still in the room with us. I mentioned it earlier. Wages have been growing faster than all inflation gauges. So with that being said, Michelle, where are we at on inflation?
Yeah, so we didn't get the much feared recession. And in fact, economic data turned out to be better, as I just mentioned. That was the good news. However, in the not such good news camp, inflation in the first quarter was a bit stickier than expected. And I can start with the good news, and that's that headline inflation has declined significantly since mid-2022. The Federal Reserve's preferred inflation measure, which is the PCE, or Personal Consumption Expenditure Index, fell from a peak of 7.1% year-over-year growth in 2022 to just 2.4% as of February 2024, putting it very close to the Fed's target of 2%. Unfortunately, the widely watched CPI, or Consumer Price Index, has been less well-behaved. While progress for the CPI, which has some computational differences from the PCE, has been dramatic, moving from 8.9% at the peak to 3.2% year over year as of February, improvements for that indicator have stalled. So, the CPI has stubbornly hovered around 3.2% since October of last year, and that's sparked some concern that it won't have a further meaningful decline from here.
So, as an advisor, as a market participant, and a market observer, it's crazy to me to see markets still react so hyperbolically to CPI. The Fed has been quite clear that PCE is driving most, if not all, of their decision making. And as you said, it's been a more friendly measure, and in my opinion, signifies components that the Fed actually has some control over or are calculated more consistently in line with current inflation trends.
Right. And if we break it down, the main culprit in the hotter core CPI print in March was shelter, which has accounted for about 60% of the total 12-month increase in core prices. And I won't go into great detail here, but there is some questions around how the CPI measures shelter, but suffice it to say it has its skeptics. As for the headline inflation, which includes the more volatile components, energy prices were definitely the big contributor there, as gas prices have increased on geopolitical tensions in recent months. Some other components which were not well behaved included motor vehicle insurance, personal care, education, healthcare, and some parts of food, in particular eating out. However, core goods prices continue to trend lower as supply chain distortions related to the pandemic and Russia's invasion of Ukraine continue to fade. And even with the recent conflict in the Middle East, supply chains are still in good shape, and goods prices should remain contained. So in our view, while the ride down will be bumpy and may take slightly longer than anticipated, the overall disinflationary trend established in 2023 remains in place. And we'll get another important data point this Friday when the U.S. Bureau of Economics Analysis releases the most recent PCE data. Again, that's the Fed's preferred inflation index.
Okay, speaking about the Fed, let's talk about the Fed. So inflation has been stickier, which historically happens in the last mile, as we know. I'd be curious of your view here, but quickly, here's my take. Take the Fed and Jerome Powell at their word. We learned this lesson on the way up and with rate hikes, and I believe we're going to learn this lesson on the way down as well. The Fed has used their communication tools to telegraph exactly what they're going to do. I know there might be some deviations during different speeches between meetings, but a lot of those happen from non-voting members that really don't have a say in policy. So when the Fed speaks as a whole in an official capacity, they're pretty consistent. So at this point, the median estimate for cuts, as we can see here from the FOMC minutes, is 3 this year. It doesn't mean they're all going to happen now. It doesn't mean that they're going to start happening now. This could certainly come near the end of the year. But either way, I believe they're able to cut. And even with these cuts, it leaves the Fed fund rates at a restrictive level well above their long-term neutral rate goal. I mean, current rates really aren't as restrictive to areas of the market that we're seeing consistent growth. However, they have certainly slowed things like transactions in housing, stretched commercial real estate sectors, as I will discuss later, and are impacting smaller businesses that are affected by these variable rates. So recently, since November, the Fed's language has pivoted a bit. It's not entirely dovish, but they've certainly moved from the hawkish language of 2022 and most of 2023. And I really believe Jerome Powell wants to cut because he can and doesn't want to, or wants to avoid having to cut because it's needed. So he's got little left here from a risk career standpoint. So his opportunity is to land the plane and do so before the Fed overstays their welcome. So, Michelle, that's my take. What do you think?
Yeah, I agree. And I might add to that by describing it with a view to what it means for market expectations. So at the start of this year, with inflation having made significant progress toward the Federal Reserve's target in 2023, optimism was very high for rate cuts, and the bond market was pricing in 5 interest rate cuts by the Fed for 2024, with the first one expected to be in March. Now, we always thought that was way too aggressive. Obviously, a lot of that has been priced out now with the higher inflation numbers. And as we talked about earlier, inflation in the first quarter was higher than expected, and that's caused the Fed to alter their narrative, indicating that they call it greater confidence before they begin cutting rates. But to your point, Dominic, the various Fed officials have had a uniform message that their bias is to cut interest rates this year. It's just that the magnitude and the timing has become less certain. Still investors have adjusted to the idea of fewer rate cuts by pushing longer term interest rates higher. And so in tandem with this backup in yields, the equity market has had what, I would call a healthy correction, with S&P 500 declining 5% as of last Friday. And that's 5% off its most recent high. So Dominic, this brings us to the recent sell-off. Clearly investors got pretty excited about rate cuts, which are now being pushed out. Yields have moved higher and the stock market has taken a breather. From an advisor perspective, how do you advise clients in these circumstances?
Yeah, it's a great question. And the short answer is stay invested and keep investing. And I know that's definitely easier said than done. So let's quantify this a bit more with some confidence. As we can see on the slide here, intra-year pullbacks are healthy. And despite average intra-year drops of 14%, which includes outlier years like 2008, annual returns were still positive 33 out of 44 years, or 3/4 of the time. And if we look at the negative years, I don't think I see a year on this chart where the annual returns equaled that drawdown. So meaning if you started the year invested and stayed invested, even those 11 years, you were better off riding out the drawdown and, again, staying invested. So let's talk about pullbacks. Pullbacks happen for lots of reasons. As you mentioned, Michelle, I think this time we got a little ahead of ourselves on the rate cuts and had a meteoric start to the year. We've also got a lot going on from a geopolitical perspective. But if we look back historically, it tells us that the market often overreacts quickly to the downside and recovers just as quickly to the upside most of the time. These events are largely out of the purview of the market, no matter how ugly they tend to be. So, again, putting pullbacks in a different context, without them, we really can't get future expected returns, or at least they tend to be stunted. So these are not only healthy, but they're great opportunities if someone is still allocating to their portfolio, has been saving cash on the sidelines, or hasn't really fully allocated at all. So I look at this as opportunistic moments for most clients. So again, just to recap, like I said, my advice is to stay invested and to keep investing. The best time to buy, in my opinion, is always now. That's because timing the market doesn't ever really work out. So in practice, this definitely becomes more difficult. Just when we want to allocate more or stay the course, every headline tends to tell us to go the other direction. But market history and returns tell us that this is not the right answer. Buying pullbacks is hard, but tends to lead to higher returns. So switching gears here a little bit and getting back to rates, I know one sector that could really use some interest rate relief, and that would be real estate. So back in January, we briefly touched on the different real estate sectors and the impact of higher rates, both in the residential and the commercial real estate markets. We got cut off a little bit on time, so let's dig in a bit more here today. So let's start out with residential real estate, since this one's a bit easier to chew on. And no pun intended, hits home for most investors. It tends to be their largest asset, or most amount of equity in their portfolio or balance sheet. The best way to put it would be higher interest rates have hit residential real estate on a volume basis but not a price basis, meaning mortgage rates at all-time highs. We're above 7% again. Home sales and inventories pretty much just came to a grinding halt, as you can see here in 2023. I guess the good news is this had little to no impact on actual home prices. 3/4 of homeowners with mortgages have them fixed at 4% or even lower. So higher rates really don't mean anything to them. It just means they're likely not going to move or sell their house. The days of subprime underwriting and the voluminous arms in the market just haven't applied this time like they did in the financial crisis. No one's really been needing to sell or being forced to sell through foreclosure. So instead of dropping prices, we're just seeing fewer people selling and, again, fewer people buying, especially when the rates spike above 7%. Moving into this year, though, I believe we've seen kind of a second act here, and this is now where buyers are starting to come back into the market. I think they've accepted that rates really are not going back to sub 4% or maybe even 5% anytime soon. So some buyers are just accepting the higher rates, and others are looking for creative options like assuming current owners' mortgages or having them buy down the rate. And then there's another group that's looking to family or friends for gifts to facilitate down payments, kind of another form of creativity if you have the resource. So kind of seeing an expedited inheritance strategy almost, where some instances where you have parents of the baby boomer generation gifting their kids down payments. It's coming from a pool of assets that's likely to go to them in the future anyways, but now they're putting it to work in their kids' homes. And this is at the same time, a group that's had relatively large success with their portfolios and other asset prices of things that they own. So they're being given a chance to kind of pay it forward. I know that's not the instance for everybody, but it's definitely something we're seeing happen quite a bit. I think the next shoe to drop or seen here would be when rates do get cut and mortgage rates start to fall. Like I mentioned, I think we're untethered from the 3 to 4% range, and buyers have kind of accepted the new mortgage rate reality. So I think it'll be interesting to see how fast we get back to this increased bidding wars and concessions by buyers. I think the market's really just become untethered from where we were in late 2022 and throughout 2023. And we really have people sitting on the sidelines ready to jump in. So similar to the stock market, again, with all that being said, I think waiting for the exact best time to buy tends to kind of be a fool's errand for all those reasons.
Yeah, so we're not seeing anything like 2008 and 2009 where people lost their homes. Things are stagnant, but nothing, is moving really in a negative direction. What about the commercial real estate sector?
Yeah, so a little more complex for sure, and a lot further reaching implications for the broader economy given the potential risk here. But a quick reminder from our last discussion, the office sector, which in commercial real estate seems to be what's keeping a lot of the investing world, banks, and headlines kind of up at night. But office buildings make up about 15% of all commercial real estate. And about $1.5 trillion of commercial real estate is being refinanced in the next 2 years. So first off, I think we need to realize that's not unusual on its face. A lot of commercial loans adjust on 5-year intervals. They're not like residential mortgages that have long-term fixed rates. So the issue is they're being refinanced at a time where rates have risen quite a bit, feel more restrictive, and are still expected to be fairly high over those next 2 years. So the second part of this is who holds those loans, and it's largely regional banks, which, as we saw last spring, were under a lot of pressure from rising rates already. So there is some concerns there about another bank panic. So far this year, though, things have panned out okay. Say most of those commercial loans not in office space have continued to see healthy rise in tenancy. But certain metropolitan areas for office space, they have not, and they're largely having to do two things. Either sell at a discount and take a loss on their books, or really what we've seen more of is kind of work it out with the bank, which we could see as kind of kicking the can down the road. That doesn't seem too great, but here's the thing. I think as we saw in the financial crisis, banks do not want to take over these buildings. They do not want to have to repossess assets and then figure out a way to sell them themselves. They'd rather work things out because they know that's kind of a losing proposition for them. So if they can come to the table, both sides, work it out for the time being, they're both much better off, as we know. And we're seeing a lot of that happen. I'd say the silver lining here, though, is the possibility of opportunistic real estate and real estate debt investments starting to pick up as a lot of these discounted sales are happening. So that's something I'd be looking forward to. All right. So I know, as we mentioned, real estate's having some challenges, but let's talk about what went unchallenged, or at least in 2023 was unchallenged. A lot of the story was the Magnificent Seven, which we heard a lot about. It outpaced not only the S&P 500, but the NASDAQ by leaps and bounds. I know the bears used these stocks to tout concentration risk, how narrow the market rally really was. But as the year went on, the rally began to broaden. And now it feels like stocks cannot pull the market up forever, or a handful at least. So hopefully this broadening continues. But what are you seeing, Michelle, in regards to the market breadth and the broadening of the bull market that we've been in?
Yeah, so US stocks have rallied significantly over the last 2 years. And as you mentioned, that has been largely driven by companies with ties to artificial intelligence, those creating the technology, think Microsoft and NVIDIA, or those who have access to the data which is needed to implement the technology, think Google, Meta, and Amazon. However, as these stocks have become more expensive, investors are turning towards firms set to actually benefit from the productivity gains of adopting AI within their business, which is almost every sector from healthcare to manufacturing to financials and more. Additionally, investors are looking forward, for companies that are going to be benefiting from a boom in U.S. infrastructure spend, which we're going to be talking about here in a minute. So the Magnificent Seven have had their extraordinary run and appear to be taking a breather. We're still very bullish on the long-term secular trends for these companies, but would really welcome the opportunity for to see them rest and let fundamentals catch up to current prices. And while the Mag 7 are taking a beat, the market is broadening out in a very constructive way.
Yeah, so here's my quick adage about market sentiment that relates to the Magnificent Seven. And in general, it's easier to be bearish on the market. Risk and loss aversion make it so. So we're always looking for risks and pointing to them as the future culprit of a significant pullback. Doing that will always happen. In this case, though, market concentration at the top is not something that keeps me up at night, at least. The indices have always been historically concentrated at the top. It does not lead to downfalls. It simply leads to rotation, different companies or sectors coming in and out of favor. So my take is that simple diversification, which most investors do, already solves a lot of this for most of them. So enough about stocks for the time being here. So let's move on to bonds. Michelle, bonds are back, in my opinion. And I know bonds aren't super exciting for a lot of people, but to me they are. And at these levels, they certainly are. So yields are still hovering at 15-year highs. And cash in most places is actually paying a decent yield. What's the problem? Well, we have over $6 trillion in money market funds, and that's a record high. The question is, are investors using money market funds for saving or investing? Don't get me wrong, money markets are a great place to park cash for emergency funds, earmarked expenses, or defined short-term goals. The risk here, in my opinion, is investors are using it as a proxy for longer-term exposure to these other asset classes without understanding the risk. And yes, there are risks to money markets and cash. In this case, we're talking about what's known as reinvestment risk. I get it. Money markets are paying north of 5%, and you have nearly instant liquidity. When you're comparing that to either treasuries or bonds with longer maturities, maybe paying less than 5%. So why would you add any duration or move, to more bonds versus keeping, your cash in a money market? It's because your money market yield is variable, and that dynamic will shift. And history tells us it will happen very fast. And that's going to tend to come when rate cuts happen, or even looking forward to rate cuts. So before we go any further here, let's take a look and talk about the yield curve. So as you can see on the slide here, the yield curve is still inverted, meaning short-term rates are higher than long-term rates. Remember, you should be paid more for parking your money somewhere longer. It seems pretty intuitive, but right now, that's not the case for most of the curve. Short-term concerns about growth and inflation have resulted in this inversion, but we will return to a normal yield curve. The question is how and when. So a few things could happen. Looking at the yield curve again, lower rates could rise and shorter rates could fall. Or we could see a combination of both. Long-term rates are reflective of long-term growth and inflation in the economy. So this makes it very unlikely that a move solely on the long end above short-term rates is how we return to normalcy. So my guess is we see long-term rates rise ever so slightly, reflective of the robust growth that we've been seeing. But we largely see short-term rates fall in line with Fed rate cuts and the continuation of those expected cuts. But again, that's my best guess. So Michelle, what are your thoughts on the curve?
Yeah, our base case is the bull steepener scenario you described, where the short end of the curve declines as inflation returns to target and the Federal Reserve cuts short-term rates. As it relates to the opportunity cost of holding cash, I completely agree. Money that's intended for long-term goals and objectives should be held in long-duration assets. It's sometimes described as matching assets to liabilities. At the peak of the interest rate cycle where we believe we are now, there's always been a better opportunity than cash, which carries its maximum reinvestment risk when interest rates are topping out.
Okay, so let's return here to what should be in a money market. This is advice I give clients, and I want to be fairly specific here. So what should be in a money market versus allocated elsewhere? Certainly, every investor has different risk tolerance and a different time horizon. But in general, when we're thinking about what should be in a money market fund, we're considering cash that's set aside for an emergency fund. Other short-term expenses that someone has earmarked, such as tax liabilities or other expenditures, can be held in a similar fashion. But if you have a predefined timeline that's over a month or so, then you could certainly look at things like short-term treasuries, given their fixed rate, if held to maturity. Any assets in addition to these purposes typically should be allocated to a client's longer-term portfolio, whether that's stocks, bonds, or a combination of them. Again, the risk is holding too much cash in short-term instruments that have variable rates. On top of this, with the significant amount of rate hikes we've seen, we start to see duration risk is now asymmetric to the upside. I know rates could still rise. That is very unlikely, though. But with over 500 basis points of hikes in place, the likelihood of that and the short-term impact of duration risk is so much less than it was a year ago, let alone 2 years ago. So my biggest fear here is that investors have become pretty complacent with cash yields. Rates begin to fall and opportunities in longer duration assets dry up first, and then they realize that after the fact. At that point, longer-term rates have dropped and money market rates have dropped at the same time. So the opportunity would be looking into longer duration before those moves happen. We saw that benefit from equity markets too last year, even compared to these higher cash yields. And I think we'll continue to see that from fixed income as well as equity over the long term. So even with the recent inflation readings pushing rates up ever so slightly, to me, that's an opportunity. The door is open again a little bit to capture some of these higher rates, so investors have a chance to take advantage of that rate environment again.
Yeah, and Dominic, I would just add here that we expect the return of negative stock-bond correlations after a rough go in 2022 when that was definitely not the case. And the main reason we think that is that the rapid rate hikes of 2022 and 2023 prove that central banks are committed to anchoring inflation and inflation expectations. And what's more, they are finally seeing that inflation is moving toward their 2% target. In addition, inflation expectations, especially short-term expectations, have come down meaningfully. If you look at historical data, it shows a favorable negative stock-bond correlation is closely linked to relatively low and anchored expectations for inflation. So in short, we believe bonds will once again be that ballast in a balanced portfolio at these yield levels.
All right. So to finish up for today, our final topic that we wanted to discuss was opportunities in infrastructure. So both at home and abroad, public and private investments in infrastructure initiatives have been dominating the investment headlines. Investing in emerging industries like AI and other tech-adjacent initiatives, as well as the focus on improvement of our logistics and transportation networks, has been a priority, and it's now receiving heavy amounts of funding. Question for you, Michelle. What specific tailwinds are these sectors experiencing, and where are the public market opportunities?
Yeah, so government spending programs supporting infrastructure and onshoring initiatives in the US, like the Investment and Jobs Act and the CHIPS and Science Act, are just really hitting the market now. The IIJA, which is aimed at upgrading the country's aging infrastructure, has already awarded funding for 46,000 projects nationwide. And meanwhile, through the CHIPS and Science Act, the U.S. government will be providing up to $53 billion for American semiconductor research, development, and manufacturing in this country. In recent weeks, we have seen allocations to the likes of Intel, Taiwan Semiconductor, and Samsung, among others, to build chip plants in the U.S. Private investment in infrastructure is also booming. And recently, NVIDIA CEO Jensen Huang just said recently that he predicts that organizations will spend about $1 trillion in the next 4 years to build and upgrade data centers. These data centers require enormous resources in areas like engineering, construction, transportation, heating, ventilation, air conditioning, steel, process automation, energy and materials, among others. These are the sectors in the public market that are benefiting. This government support for infrastructure build is not exclusive to the US and is happening all over the world. And just to highlight one rapidly growing part of the world, in India, the government plans to allocate 3.3% of GDP to infrastructure initiatives in 2024, with particular focus on transportation and logistics segments. India is growing really quickly through these initiatives and has been a standout in the emerging market sector for the last year or so.
Yeah, so beyond the public markets, investors can gain exposure to infrastructure sectors, both direct and adjacent, through private investment funds and other non-public vehicles. So this would certainly require qualifying as specific investor types similar to other private investments. But infrastructure investing tends to be a staple of private investment portfolios, given more direct investment in infrastructure has been available in private markets in comparison to the public markets. So let's start out with some downside of private investments. Like other private investments, you're dealing with a level of illiquidity. Depending on the fund structure, you could have specific lockup periods and penalties to liquidate your holdings. Another one would be the underlying asset values are not updated as frequently, certainly not anywhere near the public markets being updated on an ongoing basis. On the other side, though, one of the biggest advantages here is that most sectors in the stock market tend to have some correlation to the greater market, and definitely more so than private investments. So this behavior leads to assets behaving, in line with the general stock market versus how the underlying asset or sector may be truly faring. So with private and market investments, you tend to get more direct performance from the asset versus the stock market. Another advantage would just be the exposure as a whole. A lot of infrastructure assets simply are not accessible via public markets, where you find more infrastructure adjacent businesses. Lastly, more tax efficient cash flows can be found in private market infrastructure, given the corporate structure of these companies, the holdings of a private fund, or sometimes just the fund structure itself. So this can be positioned for specific investors a lot more strategically than public infrastructure stocks with traditional distributions.
Yeah, and in addition to what you described there, Dominic, core or strategic essential service type assets in GDP sensitive areas or in regulated or contracted power can provide, not only the diversification and tax advantage income you described, but can also be a hedge against inflation, as these are they tend to be long-term monopolistic contracts, and they often have inflation-linked escalation clauses. So if we're wrong about inflation, and inflation continues to be a problem, infrastructure is a good place to place some money for that purpose. As with other private investments, investors do need to take all risks into consideration, dependent on their investment objectives, individual tax situation, risk tolerance, and long-term financial and estate plan.
Great. So, that's all we had prepared today, but I think we have a few extra minutes. So I think we can go through maybe one question here with the time we have, Michelle. So okay. Let's see. So I keep hearing that the market is expensive. What is your view here?
Yeah, we do hear that a lot, and valuations are stretched at 20 times forward earnings for the S&P 500. However, that multiple is elevated by just that handful of names we talked about, the Mag 7. And investors expect to see outsized earnings potential there. So those those PE levels may be warranted, but the broader market is generally fairly valued. And though much of the increase in the stock prices has been driven by multiple expansion in the last, say, year and a half, the macro backdrop does look very supportive for stocks. And, the U.S. economic growth is still solid. Inflation is gradually receding, and the Fed, is expected to cut rates, albeit the timing is uncertain. So even if negative catalysts, emerge that impact sentiment and multiples, profit growth is expected to accelerate from 0% last year to 11% this year. So earnings growth could just reliably drive equity performance, that is, as it has done, for the last 3 decades.
Yeah, I would just add the dynamics of the companies that we often are told are stretched, not only are being demanded by their growth, but also the structure of those companies themselves. They're not necessarily silos operating in one sector. They have pretty amalgamations of businesses that are much more efficient than really we've seen in history. So until that change happens, if it does happen, first of all, or if there's any sort of regulation around it, I think the multiples they're demanding make sense. So, all right. With that, I think we'll wrap it up here for the day. We do appreciate everyone joining us. If anybody else has any questions or comments, I think we'll have our contact information up for you all to reach out to us. Again, thank you for joining us, and we'll see you next time.
Thank you, everyone.
Great. Thank you, Michelle and Dominic, for a great presentation today. And like they said, if we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. And here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this as your survey, as your feedback is very important to us. Thank you for joining us, and I hope you join us again next time.